Hi everybody, my name is Mike Deschamps. I'm a professor here at Miracosta College in the accounting department, and I'm going to help you out today with some of the stuff that you need to review for the CAT exam. And I'm going to be focusing on two areas today. My first video, which is going to be one of three, is going to be an inventory review. My second video is going to be on the closing process. And then my third video is going to be looking at some questions that may appear on the exam and just to walk you through some solution efforts in regards to that. So this first one, as I said, is going to be inventory review. And as we get to the next slide, just a brief encapsulation of what you'll be looking at when you take the CAT exam, or commonly known as Knowledge Assessment Exam 301. So 50 conceptual and computational multiple choice questions. You'll have a maximum of an hour. And the good news for you is that this test is primarily focused on financial accounting, so you don't really have to worry about a lot of the managerial concepts that you learned in 202. So that said, let's get started. And the first thing I want to kind of go back over real quickly is the accounting cycle. And as you can see from this slide that we have on the screen, that there are a number of things that go on in order to complete the accounting cycle. And because it is a cycle, right, we go from beginning to end, and then we start over again. And one of the things I do want to point out is that our starting point is always the analyzing of transactions. And the key that we want to bring to the table with that is, was there an economic event? If there was an economic event, then it's going to be captured and recorded by the accounting system. If not, it doesn't mean it's not important information, but it's not something that's going to make its entry at this point into the accounting cycle, though down the line, if an economic event actually is the result of what was discussed in that first transaction, then we would capture it, right? And then we go through the journalization, we post to the various accounts, we have our first unadjusted trial balance, and then we adjust that, we prepare the adjusted trial balance, we prepare the statements, and then we get into the closing process and the post-closing trial balance. And something here in step 10, which we really don't probably spend enough time in financial accounting, just because there isn't enough time, but it's something that we do cover in the bookkeeping course, Practical Accounting 1, is reversing those entries that often happened at the end of the year. You know, we talk about the adjusting journal entries, which in the next time period, many of them are going to be reversed out. So that's what that relates to. And then we go back and we start the process all over again. Now, when we start talking about inventory and the sales of and things like that, we got to recognize that there are several different aspects of companies or organizations that companies can encapsulate. And we have in this slide service companies versus merchandising companies. Service companies are very easy, right? They provide a service. Whatever the cost of that service was is an expense. It makes it real easy, as we can see right here from the midpoint on the slide, to figure out what their net income is. But the minute we start talking about a merchandiser, they are going to have something called cost of goods sold. Now, cost of goods sold is an expense. It's one of the first expenses that we saw that did not have the word expense attached to it. But it is an expense. Therefore, like every expense, when we have it, we debit that account because we always debit expenses. So what we're talking about here, though, is that when we have cost of goods sold, it gives us this intermediate point, gross profit. Now, gross profit, as we've covered in the past, does not mean that's what you're putting in your pocket, but it's giving you an idea based upon what you sold the good for and what it cost you to sell it, either to buy it from someone else or to make it. Then that gross profit is important, because if your gross margin isn't large enough, at the end of the day, when we circle back over here to net income, you might not be making that enough. So gross profit is a critically important dimension that we use in the accounting process to determine if we are really making enough on the goods that we're selling. Now, when we talk about a merchandiser, you know, we have this cycle, if you will, and it starts out with you've got cash. Remember, cash is king, because as shown on this side, cash allows you to do things. You can make purchases, and these purchases are going to be inventory, right? So inventory is very important. We have to manage inventory carefully, right? Because we don't want to have too much inventory, because if we do that, it's tying up all our cash. And if we don't have enough inventory, think right now with this pandemic that we're going through, and if you try to go out buy wipes or other cleaners, not enough inventory, right? So if you don't have enough inventory on sale, people are going to go someplace else. And then oftentimes people aren't going to pay us cash for what they bought, so we have credit sales, and we have to collect that. We have to make sure that we're diligent in collecting it, and if we're not, we're basically going to lose money, all right? And so then we come back to the issue of we have cash. Now, when we talk about inventory, again, it's critically important because if I am in a business that sells inventory, think Target, think Amazon, think Walmart, all right? I've got to make sure that I'm keeping good track of this inventory because it's going to be, for a merchandiser, one of the largest cost items on the balance sheet, right? So we have this thing called beginning inventory, which is what we didn't sell the last period, right? Even though we call inventory a current asset, and we do that under the assumption that we're going to sell everything that we bought, we know reality is we don't often do that, right? There's always going to be some stuff left over. And so we have beginning inventory plus my new stuff, and this gives me this concept called merchandise available for sale, or as I like to call it, all my stuff. This is all the stuff that I could send you and sell you in this particular period. And for this all my stuff, we can quantify that in two ways. We can quantify it by the dollar amount of the merchandise I have available for sale, and also the number of units of merchandise that I have available for sale. Now, at the end of the period, this total cost and this total number of merchandise available for sale, again, all my stuff, is going to go to one of two places. Either I didn't sell it and it's going over here to ending inventory, all right, or I did sell it and it's over here in cost of goods sold. And once it moves over here to cost of goods sold, it means that we're going to record that on the income statement, whereas if it stays here in ending inventory, it remains on the balance sheet. So one thing we need to understand is that when we're talking about merchandise available for sale, at the end of the period, it's going to get bifurcated or divided into two situations. That which stays on the balance sheet, ending inventory, that which is going to the income statement, cost of goods sold, which, as we just pointed out a few moments ago, is a critical aspect of determining what my gross profit is in terms of selling these items. Now, we also learned in our journeys in financial accounting and perhaps even practical accounting that there are two basic inventory systems. We have perpetual systems and periodic systems. When we talk about perpetual systems, it's critically important that we understand that this is GAAP, all right? If you are a company that either has to be guided by GAAP or chooses to be guided by GAAP for reporting purposes, you're going to be using the perpetual system, And when we talk about that, what that simply means is that every time I either gather inventory into the system or I remove inventory from the system, which would be a sale, I'm going to be constantly updating those numbers, all right? So with a perpetual inventory system, generally speaking, it's going to give us in real time what we have left in inventory and what we've recorded in cost of goods sold. And that's important to us because real-time information allows us to make better decisions. And so when you go into the grocery store and the checker is running your things through the scanner and you can see the prices pop up on the screen, that certainly is one important function of what they're doing. But at the same time, that system that the scanner is tied to is adjusting my inventory and also recording cost of goods sold, because if you just bought that box of cornflakes, then I have one less box of cornflakes in inventory, and it is now updating that. So at the end of the day, when inventory gets to a certain level, it's going to alert me that it's time to get some more cornflakes before we run out of them. And we know that that's going to upset people that love cornflakes, all right? Whereas in a periodic system, we really don't know what has happened until the very end when we go through and record an inventory. So the way I like to describe the periodic system is you're kind of flying blind for a whole period until you actually do the count to figure out, oh, what did I sell? What did I have left? So we don't see the periodic system used that much anymore. With the advent of barcode technology, just about anybody can be on a perpetual system, but you find some small mom and pop stores that still use a periodic system, but even then, it's few and far between. So a couple of quick questions based upon what we just discussed. The first one, I'm going to work from left to right, true, false to multiple choice. It says a perpetual inventory system continually updates accounting records for merchandising transactions. The correct answer is true. All right, that's where the word perpetually comes. I like to call it Our Lady of Perpetual Inventory. All right, because it's always being adjusted every time something happens. The next one, right below it. Under a perpetual inventory system, the cost of merchandise purchase is recorded in the merchandise inventory account. True or false? And the answer is true. All right. So in other words, let's say that you spend $1,000 for inventory. You're going to credit cash for $1,000 and you're going to debit merchandise inventory for $1,000. Now the last one we have on this slide is over here on the right, and this is our multiple choice question. It says the recurring steps performed each reporting period in preparing financial statements, starting with analyzing and recording transactions in the journal and continuing through the post-closing trial balance, is referred to as the answer number C, the accounting cycle, right? Where we go through and we start all the way through, all the way to the post-closing trial balance, and then we start again. So another issue we have with inventory is the issue of purchase discounts, all right? Because sometimes we're going to induce people to pay a little bit early, and as a result of that, we'll give them a discount period, right? And we know that when we offer someone a discount and they pay within those terms that we specify for that discount, that we're going to get less money than we originally sold them for, the inventory for, but we're going to get it quicker, hopefully, and that's going to allow us to go out and do more things. So when we talk about the issue of purchase discounts, we have terms. And up on the screen you see what are some basic terms. 210 net 30. The 2 represents the amount of the discount. 10 is the number of days that the discount will be available. And if you don't take advantage of the discount, then everything is going to be due within 30 days. So on November 2nd, Z-March purchased $1,200 of merchandise inventory on account if they had no cash. Credit terms are 210 net 30. And I don't want to belabor the obvious here, but if they're paying cash, we're not going to be extending credit terms to them. So we debit the merchant's inventory for $1,200, which we sold them to that for, and accounts payable for $1,200. All right. So this is my initial journal entry when I sell them the merchandise. Now, what's going to happen on November 12th, Z-Mart paid the amount due on the purchase of November 2nd rather. So they paid within the 10 days, so they're going to get advantage of the discount. And in that case, it was 2% of $1,200, which is $2,400. So do pay attention to how this journal entry works out. We are going to reverse out the accounts payable for the total amount that we originally recorded it on. We credited accounts payable for $1,200. Now that they're paying us, we're going to debit accounts payable for $1,200. But instead of getting $1,200 in cash, we're only getting $1,176 because they took advantage of the discount. And the plug, if you will, to balance the journal entry out is that we're going to reduce the cost of the inventory by $24. That's the amount of the discount. And so now what has happened is we have encapsulated the entire journal entry with these 3 pieces, reversed out accounts payable, recorded cash at the lesser amount than what we originally thought we were going to get. The plug, if you will, is to merchandise inventory, which we reduced by $2,400. Now, sometimes people get goods from us and they don't find them acceptable, and so what happens is they want to return them. And in the event that they return goods, what we know is that it's going to go, if there's nothing wrong with the goods, we're going to put it back out there for sale. All right? And if it is defective, then we're not going to put it back out there. So in this case, what happens is Z-Mart says, look, $300 worth of the stuff was defective. What we're going to do is debit accounts payable, so they no longer owe us for $300 of that amount, and we're going to reduce inventory by the $300 that is defective merchandise. So Z-Mart purchased $1,000 of merchandise on June 1st with terms of 210 net 60. 2 days later, Zmart returns $100 of goods before paying the invoice. When Zmart later pays on June 11th, it takes the 2% discount only on the remaining $900 balance. Now that's critically important because to the extent that you return goods, in this case Zmart returned 100, then the discount isn't going to apply to that because you're not really going to pay me for that. So June 1st, we have the sale. And notice this is what we call the gross method, because until we know that they're going to take the discount, which we won't know for a few days, we're going to record the sale at the gross amount, which we do. On June 3rd, what do? They send back some merchandise. All right, it's going to lower the amount that they owe us. It's also going to lower the value of our inventory. And on June 11th, they're going to pay us. They're going to take advantage of the discount, but the discount is going to be on 2% of $900, which is $18. So the remaining accounts payable, as we can see on the screen here, gets debited out. Merchandise inventory gets credited $18 for the discount, and they're going to give us cash of $882. After we post these entries, the accounts are going to look like this as we talk about perpetually adjusted inventory. We started out with inventory of $1,200, got the discount, here's our balance. On November 12th, they owed us money. On November 2nd, they owed us money. On November 12th, we reversed it out. Balance is 0. So this is just again showing you what happens, the merchandise cost flow in the accounting cycle. All right. And the key things to remember here is that we always have this thing called, or generally do, beginning inventory plus our new stuff. So old stuff plus new stuff equals all my stuff, right? All my merchandise available for sale. At the end of the period, all my stuff is going to get bifurcated between two positions. Either it stays on the balance sheet in ending inventory, where it becomes beginning inventory in the next period, or as cost of goods sold, it goes to the income statement. Concept review here. A buyer uses a perpetual inventory system, records the cost of shipping merchandise it purchases in a delivery expense account. True or false? The answer is false. In the perpetual inventory system, the true cost of inventory is all the cost that we incur to get it ready for sale, including shipping. Now, you may have taken the Practical Accounting 1 class, which basically shows you the, not the perpetual, but the periodic method. In the periodic method, there is a delivery expense account, but kind of wipe your memory bank of that, because we're just going to be focused on perpetual method. And in that case, that cost is going to get added or capitalized to the merchandise account. Second one, credit terms of 210 net 30 imply that the seller offers the purchaser a 2% cash discount if the amount is paid within 10 days of the invoice date. Otherwise, the full amount is due in 30 days. True or false? The answer there is true, right? If you don't take advantage of the discount within 30 days under these terms, you're going to have to pay me the full amount. Quick review on a couple of key points regarding the perpetual inventory system, that we are always going to have two journal entries to record the sale. One is debit cash or AR, credit sales. The second is debit cost of goods sold, credit inventory. Therefore, if we're going to have two journal entries to record a sale, there's going to be two journal entries to record a return. One, we debit the contra account, sales return and allowances, and we credit cash. And two, providing that the inventory is still good, we're going to debit inventory and credit cost of goods sold. Just a reminder that this is what the income statement looks like when we're talking about dealing with a company that is a merchandiser and has some of these key points that we've talked about: cost of goods sold, gross profit, net income,